Hello, everybody. Thank you for joining us for today's public webinar, basically a pre-FOMC webinar. Good afternoon, Jim.
Good afternoon. We've got about a half an hour before we get the announcement, and we, as most of you have ever heard us do this before, we always add a commercial because we do these programs in order to draw attention to the educational programs that we do. The current program coming up is the intensive that starts on February 21st. There is a prerequisite to that. You must have been in a prior intensive or have completed the foundational e-course in order to take that course.
And just to clarify, the primer doesn't count as an intensive. It has to have been a prior intensive that we can verify. Okay, just want to make that clear.
But so later on, Jen will give you more details of the stuff we offer. But what I want to do right now is I want to give you some idea of how the market talks to you and how to learn how to listen to that market. And I'm going to use today as an example. Jen, get ready for to bring up the first graph I took. But
okay.
So much, one of the things that I've always laughed about over the years, I had a really good friend on one of the initial market makers on the floor of the Chicago Board Options Exchange. And one day we were having a beer and Bill said to me, you know, traders do what works until it doesn't work anymore. And initially I just kind of laughed at that. It seemed oversimplified. But as I thought about that over the years, that's probably one of the most powerful statements anybody has ever made to me. Prior to this market breaking out on the 19th, we had a non-excess high for 23. And the market went up several times, just a few ticks short of that, and then sold off. And that was nothing more than the traders doing what works until it doesn't work anymore. And now that leads me to, if Sunday night's low, I marked Sunday night's low, 49.02. And if you look at what the market did this morning, just above that. That's traders do what works until it doesn't work anymore. Now, if Jen will show the first capture I took this morning, I want to show you what short-term traders were doing this morning.
Can you see my screen?
I can. Okay.
I zoomed in a little bit here so that it would be bigger.
So if you look, the green arrow points to half back of B period. And you'll notice that the market was going to market gap lower this morning, and you got a rally, and the traders brought it up and they sold it exactly at half back from B period. That is what so many short-term traders do. It's a mechanical level, but when I see that, I know there's pretty good odds that that is short-term traders. Longer-term money doesn't work from that level very often. Now, that doesn't mean there aren't exceptions, and sometimes there are systematic traders that will use those references. I saw them use those references last June when the market rallied, very strong rally. It took it all back eventually. But so you see what happened. They sold it exactly from the C period. D period comes down, and then they bring the D period back up to the same level on C period high. Jen, show the next capture, if you will. Okay. Now look at, so that's what they did, C and B and D period exactly at half back from B period. Then you get F period, I guess that's E period, half back from D period. Now, if you know what you're doing, if you understand what the other traders are doing, what your competition is doing, you can use this to make money. We have what we call anchor trades. An anchor trade is a trade that is used by a person with a certain personality. It is a personality that it works or it doesn't work. They don't second guess it. It either works or it doesn't work. So it goes up to the B period half back and they sell it. It goes through there by a couple ticks or so, you're out. If you've got a personality that says, well, I'll watch it for a while, you don't do that. But it's a certain type of personality. They're called anchor trades. We introduced the anchor trades in order to replace scalping. Scalping is a very losing proposition, in my opinion. You don't have the same favorable rules you had when we scalped on the floor of the exchange. We bought on the bid and we sold on the offer, and we had minimal commissions if we scratched the trade. You don't have those advantages from off the floor. You're buying on the offer and selling on the bid. You're losing a tick in and out, and that adds up over a period of time. So that's the anchor trade. But the other thing is there are anchor trades, but learning how to read and observe the references is also informational. In the market, if you know how to listen to it, the market will sometimes talk to you. And that's what the market was talking to me this morning. Okay, so you see the E period high at exactly half back. Jen, let's go to my screen.
Okay. And for anybody who's come in late, I've given you the screen. These screenshots are from today, okay, just to clarify.
Yep, I took them this morning knowing we'd be live. So there's we were talking about the E period low, and you see the market comes right back up. There's the H period right at half back. So if you're, some people will step aside waiting until after the FOMC. I watched this morning and I did a couple of little trades just because I was reading this market from the exactness from here, the exactness here, and you can see it did come back up, and even this one is exacting. So there, if you learn how, I just use this reference. There's other references that talk to you in different ways, but it's like, we all know 4,900. We've seen too much trading. It's such an easy 4,900, 4,800, and Sunday night 4,902, and from that 4,902 on Sunday night, the market went all the way back up here to 49.50 some. Okay, I mean, it's so many times traders they get their emotions get involved, their biases get involved, and I'm talking about day time frame short-term traders. They don't know how to listen to the market. All right, Jen, let me take a couple of questions on what I just talked about.
I don't really see any questions right now.
Okay, so where are we coming into today? You've had what appears to me to be a tremendous amount of short covering that has taken place in the fixed income markets. You've got an inverse yield. You've got the fixed income vehicles are up substantially. I'm going to guess that there's been a tremendous amount of short covering. I think there's a tremendous amount of uncertainty going on about what the Fed is going to do today. And more than likely, what the last thing I saw was 97 or 98%. People thought that they weren't going to, make any change. So more than likely, you never know what they're going to do, but more than likely, it's that conference, that half-hour question and answer period that starts a half an hour after the release of the FOMC minutes, because at that point in time, the chairman will talk about he'll talk about what is what the release said from the minutes. That'll be pretty standard. But then it's the questions, and what people will be focusing on to see any nuances that they pick up as a result of the way he answers those questions. Okay, let me stop here. Jen, why don't you do a commercial, and then we'll come back and we'll take questions and we'll get ready for the release.
Okay, 1 second. Let me take the screen back. Okay, can you see my screen?
Yes.
Okay, for those of you that are new joining us today, maybe not as familiar with our website, jimdeltontrading.com, just want to let you know that if you want to join our mailing list so that you get our emails, you can do that in the black strip right here. And the links to our official X and YouTube account are over here. You may want to check out YouTube because we do release a week ahead video there every week, and we also publish our public webinars there as well. As you heard Jim say earlier, we do have a prerequisite requirement for the intensive. The only other way to get in without meeting the prerequisite requirement is if you have done a verifiable intensive with us previously, then you can be grandfathered in. If you go under courses at the top navigation of our website, you can get details specifically about the intensive as well as the schedule. I've got that open right here. You can download it. It's a PDF. You'll see a lot of the special presentations that we have planned. But with regards to the prerequisite requirement, that is the foundation and application of the market profile e-course. Currently, we do have special bundles, limited time bundles on sale. So you get a nice discount for purchasing more than one course. So if you haven't done the foundation e-course yet with us and you'd like to be able to join for the intensive, in order to fulfill the prerequisite requirement, you can purchase this bundle right here. These limited time bundles are only going to be available until February 11th because we know that people wouldn't have enough time prior to the start date of February 21st to do the foundation e-course properly. So if that's something that you're interested in, purchasing both will give you a nice discount. And if you've got any questions, you can contact me at the number at the bottom of our website here. I'd be happy to speak with you. Or you can shoot us an email at delton@jimdeltontrading.com. And I will leave the rest to you, Jim. You want to get back to questions?
Sure.
Okay, let me give you back the screen. There you go.
Let me say one thing before the questions.
Sure.
I've said this before, but I'm in the process of writing another book. People get all excited. It's by the time you go through the whole process and the editor and everything else, it's probably a year away. It takes forever. So don't go looking for it right away. But the positive side of that, when you do something, that means I have to review everything that I've done over the years. This substantially will update the prior two books. But the other thing it does, it is freshened so much in my mind of what I've done over the years. And I'm amazed at some of the freshness that is coming out of writing the book. And of course, that freshness will be part of the intensive. So I suspect that this intensive will be substantially different than anything else that we have ever done. Jen, I'm ready for questions.
Okay, can you elaborate on the saying that you often use, everything is a series of facts surrounded by other circumstances?
Well, sure. So you look this morning. So on step one, the market gapped lower. Okay, so we have the gap trading guidelines. So the one circumstance is the market's gapped lower. Well, now what are the other circumstances? The other circumstances is the market has been bouncing off of the 4,900 level. So the market goes down to in the overnight low on Sunday. Remember, it kind of spiked down early when Sunday night opened and it stopped right at 49.02. So that's a piece of information that I have in there. And you can see that's where the market went. If you had really strong selling, you would have gone through there. What you got was some liquidation rather than new selling today. So step one is the trend is up. Step two, you gap lower. We've got the gap trading rules, but then you monitor for continuation. You monitor for continuation. 4,900 was my support level down there, and it went to 49.2. That's part of the other circumstances. The other part, as you're thinking about this, is that it's unlikely that you get really strong money coming in to do anything prior to the FOMC announcement. Generally speaking, if larger, smarter, bigger money wants to do anything prior to the release, they've normally done that a couple of days ahead of time when there's more liquidity in the market. There's very little liquidity in a day like this. And liquidity defined as simply the ease of getting an order filled of some size. Okay, what else?
Okay. Net inventory appeared to be short coming into regular trading hours. However, the delta was positive ahead of the bell. Do you consider such nuances going into the session?
Well, yes. Remember, overnight inventory was net short, and we said that there's about a 75% probability that you will get a counter auction, which would be a rally to overnight inventory. But we also say, very importantly, when you don't get that rally, that is valuable information. And the times when you don't get that counter auction, in this case, since the overnight inventory was short and you don't get that auction, that counter auction, that's an indication that probably the market is, there's more selling out there. And of course, then there was more selling out there, went down in A, B, and C period, and it went down, fine in E period to, just a very identifiable level. Okay, what else?
Okay. The A period low and the C and D period high are within a tick. D period halfback and E period high are at the same level. Are these both observations complementary, or do they give a different message?
One more time on the question, please.
The A period low and C and D period high are within one tick. The D period halfback and the E period high are at the same level.
Well, I think I addressed that earlier on. The C period high is really what's relevant because it's half back from B period. That's what's really relevant in there. And then the D period high, it just tells you what traders were doing. They were trading from that exacting level. Okay. Now you got the H and I period exactly at half back. Again, that's short-term traders selling at those exacting levels. Now you got to be careful because short-term traders aren't always wrong, but they're not always wrong, but over a longer period of time, they are. And like I say, I made a couple of little trades today just based on that information alone. Nothing big, no home run or anything else, just saying, okay, they got the inventory too short. Now, the other comment I'll make is this market, in my opinion, since the breakout on the 19th, all I've seen in this market is basically short-term buyers in this market, short-term momentum traders in this market. I have not seen signs of stronger money. Now, the other day you had this big run-up in L period, and it was tied to for the second month in a row, I think for the second refunding in a row, the Treasury found ways that they didn't have to issue as many bonds. But you can see that, so they just got a big short covering rally, and of course it didn't last. You got this, you got the inside day yesterday. Now you got two things. The inside day, it's not a perfect inside day. It wasn't perfect. It was a little bit above it, but for all practical purposes, it's an inside balancing day. Go with a breakout from balance. But I think this was almost, knee-jerk reaction, short-term traders, no bigger money behind it, no follow-through as a result of that, and of course the market's sold off. But I haven't seen any real money in this market. And what happens a lot of times, even if there's longer term money or investment money that wants to sell, they say, well, we're not going to sell right now. The market's still going up. So they will wait. And I've always laughed at one of the common statements I've heard a couple of times. Well, we really don't like the market We'd like to take some profits in here, but we're not sure the market's ready. So we're standing with our shoulder in the door. And then when all hell breaks loose, they can't all get through the door at the same time. Okay, but all I've seen in here since the breakout on the 19th is momentum buying by shorter term traders, and I think it's added a lot of risk to this market. And then just so you can see today, when the market goes down to 2 ticks above, the 4,900 level, that's the indication of shorter term money. Look at the exactness of these days right here. I mean, it's almost exactly a little trend line, another indication of how shorter term traders trade. Okay, other questions?
Okay, is the regular trading hours close of any significance to you? I noticed that we close the regular trading hours inside of the value area most of the time, but there are specific circumstances outside of trend days where we close near the highs or lows. In theory, the regular trading hours close should represent the close of the daily auction and should be inside the value area more often than not.
I don't know. I don't pay any attention to it, quite honestly. I look at I take a much broader perspective of the market. What I do, and many of you have heard this, when the market closes at the day, because I am a short-term trader, mostly day trading, but I will do 2 to 3 days sometimes. But what happens when the market closes? My thinking is too narrow, and so immediately I go and I look at the monthly, then the weekly, then the daily, then the profiles, in order to reset what I'm looking at and start with a top-down approach and come on back down. Then I start looking at the day. But one of the things that there's in the book, I think it was one of Taleb's books, maybe it was The Black Swan. He has a section in there called talking about experts. And one of the claims he makes is there's no real experts when it comes to the markets. If you're talking about something where things are fairly regular and then there's room for experts. But in the market, he calls them a domain-specific expert. He said there's a lot of claimants of experts in the equities market, but there's very few verifiable roles. And really, what he's talking about, it's the heart of this, is there's so many irregular things that happen that it's really hard for anybody to be that expert. For example, the other day, that's an irregular thing that happened, just came out of nowhere. Nobody that I know of was looking for that. It just came out of nowhere. The market coming down to or stopping, just short of last year's non-excess high for so many days. All of a sudden you get something that takes place in China, or you get, some unusual occurrence, a speech, a political event, or some unexpected economic event. There's so much irregularity that trading that's why I say trading is an art, not a science. If trading was a science, we probably as short-term traders wouldn't have much of an opportunity because it would be taken over by the algorithms and the AI. But the fact that it's more art than it is science does leave opening for us as short-term traders. Okay, blah, blah, blah. I talked too much. What do we got? Next question.
Okay. Somebody's asking, does this look like a B-shaped profile to you today? And would you consider the E period low weak? Oh, we have a poor low.
Yeah, well, keep in mind, I keep my profiles in twos. There's
2
nothing to
tick
write home
increments
about.
for those of you that are new.
Okay, nothing to write home about the H and I high, nothing to write home about the E period low. The market's clearly mechanically bouncing off the 4,900 level.
Any comments about the B shape?
It's it makes sense. Remember, I just got done saying that this market up here was very unusual. It looked like it was just surprising everybody. And so what do you got? Big short covering rally in the market, and then the momentum traders got all excited long. Well, guess what? So then you get liquidation. That's what the B period tells us. It's liquidation, but it's not a combination of liquidation and new money selling. Right now we've got a market. We got a market that broke out a week ago Friday. We're not much above that here. Even these lows were very questionable. No excess here, but here's that that level down here, or here's the level down here where the market. There's the 23 high. So it's broke out from the 48.40 level, and so we were down this morning to 49. So you're only few handles above it. I think it's just a lot of very short-term traders in here. I think we see short covering, we see long liquidation, but I don't see any serious money. Okay, what else? Okay, we've got 1 minute. I think we'll stop right here. We've got a minute until we get to the release, and we'll just see what the market does with the release. Like I said, I don't like the HI high. I don't like the low. So, and I don't look at the release itself. I just look to see what the market does with it. One of the things I recommend is not reading the releases, not reading the news, because you're liable to get yourself a bias, whether it's negative or positive, or listen to somebody with the talking head. I look to see what does the market do with the news, what do people with real orders, what is their opinion, not somebody that doesn't have real orders. Real orders are what count. Okay, so that it's time.
Oh, Jim?
Yes.
Oh, okay. Yours was really delayed. I saw it was really delayed for some reason.
Well, I've got multiple screens and I've got an awful lot of days open. Okay, so we look down below the 4,900 level. Well, first of all, we looked above the HI. We looked below the 4,900 level. So we really, as of yet, they're pressing on that 4,900 level. So remember, there was never any excess down here. So that's, so this is coming off of a low and a high. Again, it looks like it's coming off of a very mechanical level. It's a tick or so below this low, a tick or so above this, a tick or so above this high, tick or two above this low. It still appears to me so far to be mostly very short-term money. Okay, other questions?
Okay. I hope I'm interpreting this question correctly because the way it was written, I wasn't quite sure. How do you measure tempo how do you measure tempo on the level of that it might be too much for a break?
You cannot teach tempo. You only learn tempo through experience. But tempo takes two extremes. One, when I look at tempo differently with the direction of the major auction versus against the direction of the major auction. And you're right, sometimes tempo can be too much. When you see all of a sudden, you see the market get too elongated, too stretched out. Let's say it's on the downside, gets too elongated, too stretched out. That may be just emotional knee-jerk reactions. The same thing could happen, but tempo is complex. I think tempo is probably I don't, I use this word, it's not one of my most appealing words, but tempo is like the secret sauce for short-term trading. And yes, it's one of those things that, you always have to understand the circumstances of which tempo is fast or slow or just right. But it is different. Tempo, if the trend is down and tempo really slows, that's usually an indication that the market may be getting too short. And sometimes it's an indication we need to rally before we can break further. Sometimes it's more serious than that. But tempo is extremely important. It's very complex. And the only thing I can do is point out the significance of tempo, and then you start to look at it and observe it over a long period of time. So many times traders want to learn things really quickly. They don't understand, to be a professional in anything. Take a professional in baseball. I've looked at thousands of pitches coming across the plate. The quarterback in football throwing thousands of passes, looked at thousands of formations. But so many times we want this to be immediate. Tempo is very important. I've looked at it for years, and it takes time. And yes, it does vary depending on the circumstances in which it's being applied. Okay, what else?
Okay, it was one time framing down during the ABC period. If I had wanted to get into a trade after C period, it would be better to follow the trend to sell rather than buying from the value area, low area.
Number one, I don't consider the value area buy, the value area low or high at all. It's not something I consider. I explained earlier the trades that I saw this morning. I saw, if you were an anchor trader, remember, an anchor trader is somebody that sells from exacting references. They have a very unique personality, and it either works or it doesn't work. There was an anchor trade in C period high, D period high, etc. The buys were down at the lows because the odds were so good we were coming back up to these mechanical highs. When I buy, I don't look for exacting levels. Usually, almost all my orders, I go in and I put in a market order to buy it or sell it. So many times traders get themselves messed up because they're looking for exact places to enter and exit the market. As I say, exactness kills. Okay, Jen, how long does this program go today?
Oh, well, it's as long as you want. I had put it down for a half hour because
Okay.
of the announcement, but
Okay, so let me take a couple more questions and then we'll say thank you.
okay. Would you agree that there's no excess at the all-time high?
Oh yeah, correct. No excess at the all-time high. There's now no excess at these multi-day lows. Okay, there's no real meaningful excess right here. And if you watched, if you look right down here, there's no excess right here. I mean, this market has been, as I say, I think it's been very heavily short-term traders, and that's why a lot of the excesses aren't there. They're buying at exacting levels, but that is informational. Okay, what else?
Do you also look at longer term profiles such as the monthly or weekly profiles?
I do not, and the reason I don't, because one, I'm a short-term trader. I'm a day time frame to 2 or 3 day trader. And I used to put the profiles together to look at weekly, monthly, longer profiles. What I found was it hid too much detail from me that is so important and so relevant for short-term trading. All right, let me say thank you very much. And I do hope that some of you consider our e-course or consider joining us for the intensive. And like I say, my intentions are that this will be the freshest intensive we've ever done. And so much of that is because I've spent so much time writing the book, which I said I would never do again. but now on chapter 16th and probably about halfway through the book. And I say it's probably a year until it's out in print. So thank you.
Jen, one last question here that somebody asked that was relevant. It's a question that we often get, and I just wanted to have you here while you're here, still answer it in your own words. Somebody mentioned I have been learning market profile on my own via books and have developed what I believe are the foundational skills. Would you consider accepting me into the intensive directly
The answer is
without
no.
having done the prerequisite
No,
course?
the answer is absolutely no. I have discarded an awful lot of things that were in the original book, Mind Over Markets. We no longer consider the type of openings that were described in there. We no longer consider initial balance in the morning. There's so many things that are no longer considerations. And the reason that we have the prerequisite is because we have people that have taken multiple intensives, and we're trying to be fair to everyone. And so if somebody comes in and they're not really prepared, and they want to ask questions, they want to get a value and want to ask questions, but they're basic questions, and it's not fair to take those questions for the people that have been loyal to many years. But I thank you very much. Bye now.
Thank you so much for joining us, everybody. We will post this recording on our YouTube and on our website shortly. Thank you so much for joining us. Thank you. Bye-bye.